In this video, we are going to talk about top 10 ways to avoid taxes legally. So before starting, please like this video and subscribe to How to Make Money Top 10 Videos channel, and ring the bell for our future updates. Number 10. Purchase municipal bonds. Purchasing a municipal bond entails lending money to a state or local government for a certain number of interest payments over a set period of time. The full amount of the original investment is reimbursed to the buyer once the bond reaches its maturity date. Municipal bond interest is tax-free at the federal level, and it may also be tax-free at the state and local level, depending on where you live. Municipal bonds are attractive to investors because they offer tax-free interest. Historically, municipal bonds have had lower default rates than corporate debts. According to a research of municipal bonds from 1970 to 2019, the default rate for investment-grade municipal bonds was 0.1%, compared to 2.28% for global corporate issuers. Municipal bonds, on the other hand, usually have lower interest rates. Municipal bonds' tax-equivalent yield appeals to certain investors because of the tax benefits. Your tax-equivalent yield rises as your tax bracket rises. Number 9. Set your sights on long-term capital gains. Investing can be a valuable instrument for accumulating wealth. The advantageous tax treatment for long-term capital gains is another advantage of investing in stocks, mutual funds, bonds, and real estate. Depending on the investor's income level, an investor who holds a capital asset for more than 1 year receives a preferential tax rate of 0%, 15%, or 20% on the capital gain. The capital gain is taxed at regular income rates if the asset is held for less than a year before being sold. Understanding the difference between long-term and short-term capital gains rates is crucial to building wealth. For 2020, a married couple filing jointly will pay 0% on long-term capital gains if their taxable income is below $80,000, and a single individual will pay 0% if their taxable income is below $40,000. The zero rate bracket for long-term capital gains will apply to taxable income up to $80,800 for married couples and $40,400 for single individuals in 2021. To minimize gains and maximize losses, a tax planner and investment advisor can assist in determining when and how to sell appreciated or depreciated shares. By selling stocks at a loss, tax loss harvesting can be used to offset a capital gains tax liability. The lesser of $3,000 of excess losses or the net capital loss can be deducted from other income if capital losses exceed capital gains. Losses of more than $3,000 can be carried over to future tax years. Number 8. Start a company. Aside from providing additional revenue, a side business has other tax benefits. Many expenses can be deducted from revenue in the course of daily operations, lowering the total tax requirement. Health insurance premiums, which are accessible if certain conditions are met, are particularly essential tax deductions for self-employed individuals. A company owner can also deduct a portion of their home expenses with the home office deduction if they strictly follow IRS standards. Income can also be deducted for the share of utilities and internet utilized in the firm. To be eligible for these deductions, the taxpayer must run a profitable business. The IRS considers a variety of variables, which are detailed in IRS Publication 535. Taxpayers who have made a profit in 3 of the previous 5 years are deemed to be in a profit-making business. In 2019, the Secure Act, setting every community up for retirement enhancement, was passed. Employers who join multiple employer plans and offer retirement choices to their employees are eligible for tax breaks under the Secure Act. Number 7. Maximize employee benefits and retirement accounts. Taxable income can be lowered by up to $19,500 in both 2020 and 2021 if you contribute to a 401k or 403b plan. Those aged 50 and over can increase their basic workplace retirement plan contribution by $6,500. For example, if a worker earns $100,000 in 2020 or 2021 and contributes $19,500 to a 401k, his or her taxable income is reduced to only $80,500. Contributing up to $6,000, $7,000 for those 50 and over, to a standard individual retirement account, IRA, in 2020 and 2021 will get you a tax advantage if you don't have a retirement plan at work. Depending on their income, taxpayers who have employment retirement plans, or whose spouses do, may be able to deduct some or all of their conventional IRA contributions from taxable income. The deduction is phased out at different rates for adjusted gross incomes. higher in 2021 than in 2020, depending on whether the deduction is claimed on a single taxpayer's return, a joint return, or a married individual filing separately, as well as whether the taxpayer participates in another plan. The IRS has certain guidelines for determining whether you can deduct anything and how much you can deduct. Prior to the Secure Act, anyone with 401k or IRA accounts had to take required minimum distributions, RMDs, in the year they turned 2012. The Secure Act raises the retirement age to 72, which could have tax ramifications depending on the account holder's tax status in the year they withdraw. The bill also lowers the age limit for traditional IRA contributions, which was previously set at 7,012 years old. In addition to retirement plan payments, many employers offer a range of fringe programs that allow employees to deduct contributions or benefits received from these schemes from their taxable income. Benefits from these programs are often reported on employees' W-2 statements as non-taxable amounts. Flexible spending accounts, educational assistance programs, adoption fee reimbursements, transportation cost reimbursements, group term life insurance up to $50,000, and, in general, deferred pay plans are available to senior managers and executives. Number 6. Make use of a health savings account, HSA. Employees who have a high-deductible health insurance plan can put their money into an HSA to save money on taxes. Money is put into an HSA before taxes, just as a 401k. The maximum contribution for 2020 is $3,550 for individuals and $7,100 for families. 11 In 2021, an individual's maximum deductible contribution is $3,600, and a family's maximum deductible contribution is $7,200. These funds can then expand without having to pay taxes on their profits. Withdrawals from an HSA that are used to pay for qualified medical costs aren't taxed, which is an added tax benefit. Number 5. Make a claim for tax credits. The Earned Income Tax Credit is one of numerous IRS tax credits that can help you save money on your taxes. In 2020, a low-income taxpayer with 3 or more qualifying children might claim up to $6,660 in credits, $5,920 with 2, $3,584 with 1, and $538 with none. 14 For qualifying students in their first 4 years of higher education. The American Opportunity Tax Credit provides a maximum of $2,500 per year, and the Lifetime Learning Credit provides a maximum 20% credit for up to $10,000 in qualified expenses, or $2,000 per return. For moderate and lower income persons wishing to save for retirement, there is also the Savers Credit, which allows them to earn a credit of up to half of their contributions to a plan, an IRA, or Enable account. Depending on your income, the Child and Dependent Care Credit may be used to offset eligible expenses for the care of children and disabled dependents. Number 4. Don't sell assets. Many people don't use common sense to avoid increasing their income when it's difficult. Holding on to assets until you're in a position to boost your income is one way to avoid paying taxes on investments. Instead of selling a huge amount of assets in a single year, spread out your sales. If at all feasible, store your most important investments for years when your income is at its lowest. That way, even if you earn a lot more money, you may maintain your long-term income and stay in the same tax rate. Number 3. Deduct business expenses. Creating costs is the most common approach for a corporation to minimize its taxes. The majority of a company's costs are deductible if it works to make a profit. The two most prominent are cost of goods sold and capital expenses. And you can use the deductions in a variety of ways. You should, however, be careful to stay within the IRS's definition of ordinary and essential expenses. If you want to deduct your morning lattes, you'll have to make a compelling case for why they're both routine and vital to your business. Number 2. Use of your home and car. The Lifelong Learning Credit is another tax incentive for students that decreases your tax burden based on the money you spend on education. It covers the first $10,000 you spend on tuition and educational fees at a rate of 20%. This credit, however, is a little broader than the American Opportunity Credit. It is applicable to the majority of students and can be claimed for an unlimited number of years. Both credits can be claimed in the same year, however you can claim the Lifetime Education Credit even if you've already claimed the American Opportunity Credit. This credit is also non-refundable. Number 1. Using a Lifetime Learning Credit. The Lifelong Learning Credit is another tax break for students. It lowers your tax burden dependent on how much you spend on education. It covers the first $10,000 you spend on tuition and educational fees at a 20% discount. This credit, on the other hand, is a little broader than the American Opportunity Credit. Most students are eligible, and you can claim it for as many years as you like. Both credits can be claimed in the same year, but you can continue to claim the Lifetime Education Credit even if you've previously claimed the American Opportunity Credit. This credit is also non-returnable. I hope you enjoyed our video. Please let us know in the comments area below. Thank you for being with us. Please like, subscribe and turn on the notification bell before leaving. Thank you for watching How to Make Money Top 10 Videos channel.